15 years ago, I had basically nothing invested. Today, my portfolio is worth over $800,000 built from the stock market. And honestly, the currency doesn't really matter because the majority of my investments are in international and American markets. Stock market is the same game for everyone, everywhere. In this video, I'm going to show you the exact framework I would use if I had to start investing from zero today. No stock tips, no buy this ticker nonsense, no trying to predict tomorrow. Just the actual principles that build wealth. My name is Felix Nordqvist. I became financially independent before turning 30. Not from crypto, not from rich parents, not from getting lucky on one stock. The independence came from learning how to invest systematically, consistently over time. And these are the 4 things that I would focus on if I had to do it all again. Let's start with one of the biggest debates in investing. You can't beat the market. You've probably heard this everywhere. Your coworker says it, Reddit says it, even Warren Buffett has recommended that most people just buy an S&P 500 index fund. And here's the thing, they're not completely wrong. But the truth? Well, it's more complicated. Most people refer to studies showing that around 90% of professional fund managers fail to beat the index over long periods. And that sounds like proof that nobody can do it. But here's what people miss. Those studies are mostly about professional funds. And professional funds, well, they have problems that normal investors don't have. The first problem is size. If you're managing billions of dollars, you can't just buy anything. A massive fund can't put meaningful money into smaller opportunities because they're simply too big. They're forced into the same huge companies everyone else owns. As an individual investor, you have flexibility. You can invest in smaller companies, different sectors, and opportunities that huge institutions can't touch. Second problem, fees. Many active funds charge 1% or more every single year. That doesn't sound like much, but when the market returns maybe 8 to 10% per year, losing 1 to 2 to fees is a massive disadvantage. The third problem is incentives. Fund managers are not just trying to maximize returns. They're also trying to keep their jobs. Taking a big risk and being wrong can end your career, so many managers stay very close to the index. Safe enough not to get fired. Different enough to charge a fee. So when someone says, well, you can't beat the market, what they usually mean is large, expensive funds with career restrictions struggle to beat the market. That's not exactly the same thing. Now, does this mean everyone should pick stocks? Absolutely not. If you don't want to learn investing deeply, a low-cost index fund is probably one of the best financial decisions that you can make. But if you're willing to learn, build systems, and put in the work, there are, of course, ways to improve. So what actually separates good investors from everyone else? It's usually not intelligence. It's definitely not watching the news all day. What it is, it's systems. And it's actually kind of strange when you think about it. We educate ourselves before doing almost everything important. You take lessons before driving a car, you study for years before becoming a doctor, but investing, one of the most important financial skills of your life, most people just guess. They open an account, buy something someone mentioned, and then they hope. That's not a strategy. That's gambling with a nicer interface. Systems fix that. So, think about your portfolio kind of like a pyramid. The bottom is your foundation, and the foundation should be kind of boring. Low-cost index funds, global diversification, emerging markets, things you can hold on to for decades. For most people, this should absolutely be the majority of the portfolio, maybe 70 to 80%. The middle layer is where you can own individual companies, but only companies you actually understand. Not because someone online said they would go up, not because the stock has been moving recently, but because you understand the business, the numbers, and you understand why you own it. And at the top of the pyramid, you have your higher risk investments. It could be new industries, smaller companies, crypto, bigger opportunities, but also bigger risks. The pyramid protects you because one mistake at the top cannot destroy the foundation at the bottom. Let's head on into the next system. Buying is the easy part. Everyone loves buying. You research something, you find an opportunity, you invest, and you feel smart. Selling, however, is kind of where most investors fall apart. Most people have no idea when they should sell, and without a plan, they usually make the same mistake. They sell winners too early because they're afraid of losing profits, and they hold losers too long because selling means admitting that they were wrong. And this is not because people are stupid. It's human psychology, and that is exactly why you need rules. Maybe you review every investment once per year. Maybe you sell when the original reason you bought no longer exists. And maybe you rebalance when one position becomes too large. The exact rules matter less than actually having rules. Because when the market falls 20%, you don't want to create a plan while you are emotional. You want to follow a plan you created when you were calm. Easy peasy. And this is exactly where people misunderstand buy and hold. For index funds, buy and hold totally makes sense. Buy consistently, leave it alone, let the time do the job. But individual companies or individual assets, different. A company changes, management changes, competition changes. Heck, the world changes. Holding a company forever without ever questioning why, that's not investing. That's attachment. Good investors don't marry stocks. They own them while the reason for owning them still exists. Kind of like a good marriage-ish. Next up, why long-term wins. The wealthiest investors in history are usually not day traders. They're not people refreshing charts every 15 minutes. They're people who bought great assets and then let the time do the work. And there are two basic reasons why this works. The first one is behavior. Most investing mistakes happen because people react. Bad headline comes out, the market drops, someone online says everything is over, and suddenly you make an emotional decision. But when your time horizon is 5, 10, 20 years, a bad week doesn't matter. A bad month doesn't matter. You stop reacting to noise. And fewer emotional decisions usually mean better results. The second reason is that long-term thinking improves what you buy. When you think short-term, almost anything looks interesting. A stock is moving, a sector is trending, someone posts a chart. But when you ask yourself, would I want to own this for 5 years? You'd be surprised. But most bad ideas disappear instantly. Long-term thinking is a filter. It kind of forces quality. And now something that nobody basically talks about. And also probably more important than everything else. Because investing only works if you have something to invest. Capital. Before all this, I had a good job in finance, and the truth is, a huge reason I built my wealth early was not because I was some genius stock picker. It was because I saved aggressively. I didn't increase my lifestyle every time I earned more. When I got extra money, most of it went straight into investments. If I had estimated, saving and living below my means was probably 70% of the result. Investing was the multiplier. But without savings, there's nothing to multiply. And this is the most boring part nobody really wants to talk about. Everyone wants the perfect stock, the perfect strategy, the perfect opportunity. But the foundation is kind of simple. Earn money, save money, invest money. Repeat for years. Hopefully somewhat comforting to know, but you don't need to make one perfect decision. You need to make good decisions consistently for a very long time. That's how real wealth is built. Thanks for listening. See you in the next one. Ciao.